Hello and welcome to this week's episode of the Scottish Property Podcast. My name is Stephen Clark and I'm joined as always by Nick Ponte. How are you, Nick?
Yes, all good. As we talk, we've only got one day to go until you join me through the Glasgow Scottish Property Podcast networking event where I'm going to grill you, mate. I'm going to absolutely strip you down, see what the real Stephen Clark's up to.
I'm looking forward to it, mate. I've not been through the Glasgow one. I've been to Edinburgh. I've been to, obviously, Aberdeen, coming to Glasgow tomorrow, and I'm going to Dundee next month. So I'm actually really looking forward to the opportunity to get in around the different network events and meet different people. They're phenomenal. I really enjoy them.
It's going to be the first time we'll have some fancy motors parked outside the venue. So we need to try and get some pictures taken, mate, some stuff for Instagram, eh?
Nice, mate. Today's guest, we've got on Sam Norris to talk about bridging loans in specific, even though we kind of did go off topic and talk about, mortgage lenders and brokerage and what you need for your broker and what. It was a really, really good, interesting chat, but we get a lot of requests from people that join the Scottish Property Podcast Facebook page, and a lot of them ask about finance, lending, and particularly bridging loans, because when people haven't done a bridging loan, they find it quite intimidating to go down that route. So it was nice to have him on and chat over everything, and we ask them all the numbers and, what to do.
Yeah, so, dived into just basically the whole kind of application process and who it suits, who it doesn't, good lenders, bad lenders, problems with lenders. And we talk a lot about, the current market at the moment and just what's changing and about, property prices at the end. We even dived into that. So very knowledgeable guy, Sam. This is what he specialises in. He's got his own podcast as well, which puts out some great content on YouTube, social media. Follow him on Instagram, and we'll just cut to the interview with Sam Norris. Okay, Sam Norris, welcome to the Scottish Property Podcast. How are you today?
I'm doing good. Are you okay having an Englishman on the podcast? I know, don't want to cause any problems.
Don't worry, we've had a few in the past and they've all gone down well and we've not lost any listeners. It actually expands our listener base. So we've got quite a lot of listeners in England, believe it or not. Where are you based at the moment?
I'm literally, as we speak, I'm sitting in my London office, but I live in just outside of Birmingham. So, I'm a little bit closer to Scotland. My wife was born in Scotland. She was born in Elgin.
Ah, interesting. There we go.
So she tells me she's Scottish as a result of that. I'm like, well, both your parents are English. So this might be quite difficult. But
she doesn't sound very Scottish as well, probably.
She doesn't at all. She doesn't sound Scottish at all.
Elgin's a nice part of the country, definitely.
Yeah.
So thanks very much for joining us today, Sam. I have consumed a lot of your content over the years. So, brilliant job on the YouTube channel and obviously Game of Loans podcast as well, which I've listened to many a time. So it's been great. And it's great to have you on today to share some of that knowledge. And we thought we'd bring you on today to specifically talk about bridging loans and do like a mini masterclass for the listeners. So are you happy to kind of go through some commonly asked questions?
I've never said no to anyone that talks to me about bridging finance. Even sometimes I talk about it when people don't want me to talk about it. So yeah, I've got no issues with that at all.
Brilliant. Because personally, I'm interested because I've never done one before. Stephen, who's actually running late for this call, going to give him a little row here on the podcast. So he'll be jumping on later. He has experience. He's done quite a few, but personally, I'm interested. So let's just get a little bit background about you personally, Sam. How did you become a mortgage broker and involved in dealing with property investors?
Well, I'll keep the story of how I became a broker short and sweet. It is quite funny, but effectively, I come out of university, had a little job, and got called by a recruitment consultant who basically told me about this trainee broker role. So, being straight out of uni, I thought, well, stocks and shares. So I did loads of research about stocks and shares and how you invest in the stock market. Went to this interview, which turned out to be a group interview. Having done completely the wrong research, it was actually for a trainee mortgage broker role. And long story short, when we got to the sort of the one-to-one element of it, I came clean, told them that I'd kind of been missold the job, if you like. Luckily, they were a bit more annoyed with the recruitment consultant than me. And I just said, look, we've got half an hour. Why don't we split it 50-50? I'll ask you a load of questions. You ask me a load of questions. At the end of it, we'll decide if I'm right. I think there was about 12 people there and I was the only person that got offered the job. So maybe they saw something, and that was it. I fell into it. That was in 2007. So if you know your economic history, you'll know that probably wasn't the best time to get into finance.
Yes.
But I spent the next sort of 4 or 5 years struggling through, earned very little money in that period of time.
Yeah, there wasn't a lot of mortgage lending getting done after 2000.
You're telling me, yeah, and very little of it was being done through me either. So, yeah, it was a real harsh learning ground. But you know what, I come through it, which is a good thing. I've learned the value of leads and inquiries and things like that, and hopefully that shows in how I treat my clients. But yeah, sort of ended up doing a few kind of flips with my dad. So learned the sort of the development, well, not development, but refurb side of things. And in turn,
your dad's a builder, right? He's a builder.
My dad is a builder. Yeah. If you're listening to this in High Barnet, then you probably know my dad. Steve Norris is like king of Barnet.
Are you any good on the tools then as well?
Oh, when I was at uni, I did actually. I did sort of work for him as a labourer and stuff. I was more that guy that just went in at the beginning of a job and ripped everything out. That was my and I was particularly skilled at filling a skip. I would. There's no space left.
Packing it up the sides and that.
Packing it up the sides. And the key is, if you've got like fridges or something, you make stuff inside the fridge.
Yeah,
I was a very skilled skip filler. So yeah, I did end up doing a bit of the actual manual labor on the flips. And to be honest with you, I did kind of think to myself, hang on a second, what am I doing? My job in this is meant to be, I arranged the finance for this. What am I doing here? Why am I under floorboards on Christmas Eve putting blooming holes in the joists to put the wires through? Yeah, I didn't really enjoy that bit that much, to be honest with you. I think I'm better with numbers than I am with tools.
So you're starting to numbers. So you started up your own. Obviously, you've got your own mortgage brokerage at the moment, and it seems to be flying by all accounts. Taking on some staff lately and that.
Yeah, it's a struggle, but it's a good struggle. We actually kicked it off. I started it with a business partner back during the first lockdown. Funnily enough, actually, so it was June 2020, June 2020. So we're basically 2 years in now. He very quickly decided that actually it wasn't for him. Which was scary as hell for me, because I thought I'm going into this with somebody else. You lean on each other, and to suddenly be burdened with the thought of I've got to do this on my own was pretty tricky. But I bought him out towards last year, and yeah, we've been flying ever since. Brought in a couple of members of staff already. We've got 2 new starters that have just joined us in the last couple of weeks. Probably going to get another one before the end of the year. It's busy, the market is incredibly busy, and I think maybe I have a bit of a unique take on the market because I see deals every single day. I've got 4 or 5 client calls booked into my diary for this afternoon, all of which have new deals to talk to me about. And so when I see on social media, there's no deals around, all that kind of stuff, you kind of go, well, I'm seeing them left, right, and centre. So. It's a tricky one. Not saying that there's loads of really good deals out there. It's still a tough market, but yeah, it's just crazy. The phone's not stop ringing, so that's obviously a good thing.
Yeah, and are you seeing kind of like the whole of the do you deal all over, all different locations? Or I mean, as a broker, you're not really tied to one specific location, are you?
No, that's the beauty of it. And I think when I first started out, I was working in London. I was one of those really annoying typical city boys. The first office I ever worked in was literally it was almost like the Wolf of Wall Street minus throwing the short person against the dartboard. It's exactly what it's like. Everyone dressed in suits and all that kind of stuff.
And that's clearly not your personality, or that's not your style.
Not at all.
When I see you here sitting in a hoodie.
Yeah, I know. And do you know what? It was quite freeing to be able to start my own business, and actually, because I think I'm a big believer that what you put out, you get back, and so that comes in the types of people that you work with. If you're giving off a certain type of persona, you will get those kind of people back. And I actually wasn't the most successful of brokers back in the day, because I think I was sitting there dressed in a suit that I clearly wasn't comfortable with a hairstyle I wasn't comfortable with a certain mannerism that I wasn't comfortable with. And I think that lost me clients. I think people just saw it as fake. And, there are people out there that want to deal with a broker that is dressed that way, and that's completely cool. But what I do is I've been sort of freed from the shackles of having to have that type of persona. And what it's done is now the vast majority of my newer client base that have come to work with me since I've started Grand Union Finance are very, very much similar to me, because they've obviously decided that they want somebody that's a bit more chilled, maybe has a conversation with them that's a bit more human rather than just sort of reading out questions on a questionnaire. And yeah, that seems to work really well for me, to be honest with you. And it's nice to, although I'm in the city of London right now, it is quite funny. I love walking around and getting dirty looks from people because I'm walking around in a hoodie and a pair of Vans.
That northerner coming down to the big city, is it?
Yeah.
So I'm going to take a minute here to introduce Stephen, as he's come on late.
Hi, Sam. Nice to meet you.
Nice to meet you.
Thanks for joining us.
Thank you for joining us.
Thanks for joining us on your own podcast, mate. Very good.
Yeah, welcome.
We'll get Ross to cut this bit out. But anyway, I was saying to
you won't.
No, we'll just carry on then. So Sam's been explaining a little bit about his background, how he started up his mortgage brokerage and stuff like that. So we're going to come on to a little bit of a bridging loan masterclass, which is probably stuff that you already know, Stephen, but I don't. So, and probably a lot of our listeners won't know as well. So, no, but it's really interesting, Sam, what you were saying about, I mean, obviously the business side of things as well, before we get on to the bridging loans. I mean, like when you talked about setting up with a partner as well, I'm quite early on in my business as well. And it's something that I thought long, hard about as well. Do you have a view now on kind of partnerships in business? Because we know that a lot of property people get together, don't we? At the start,
yeah.
Quite often it can all go a bit wrong. Do you know what I mean?
Everything that doesn't quite go as you anticipate, you've got to use it as a learning curve. And I think with me and my ex-business partner, we clearly did not define what we wanted before we started, because as it transpired, it was, now that I look back on it, it was so obvious within weeks of us starting that we wanted completely different things out of this. We both had kind of the mentality. We'd worked for two separate companies together previously, and in both of those instances it was very much like an us versus them type feeling, that we were being let down by them. They weren't looking after us properly, they weren't giving us the platform that we needed to be successful, and I still stand by that. But that kind of binded us together against them. But so we knew that we didn't want to work there, we knew we wanted to be our own bosses, but we didn't take the time to actually discuss what type of bosses we wanted to be, or what type of business we wanted to run,
what lifestyle you wanted to give you.
Yeah, he clearly just wanted a bit of freedom. That was clear to me, that he just wanted freedom. He wanted, and that's completely cool, by the way, he wanted to run kind of like a lifestyle business, whereas my ambitions were slightly different, insofar as I wanted to build a large organization to help as many people as possible. And also, and I get wrapped for this all the time. I don't go to many industry events anymore, mainly because people look at me funny and go, "Oh God, it's that Sam bloke that bashes us all the time." I don't think our industry is very good. And there are so many amazing brokers that are working for so many crap brokerages. And I want to change that. I actually want to create a brokerage that people are proud to work for, want to wake up in the morning and go, "Do you know what? I can't wait to start work today. I've got a call with Sam today. We're going to have a right giggle on the Zoom call or whatever. Or, I'm going to have a lunch day with Sam. It's going to be great. We're going to have a right good time." Or, do you know what? I love dealing with the type of clients that we deal with. That's what I want from to build a company that is like that, because I have never worked for a company like that. Every single company I've ever worked for, I've dreaded going into the office every day, and I've also dreaded getting the sack like every single day. It literally is so hire and fire. Do you know, I worked for a company once where I got employee of the month and was sacked the next month. I'm not even kidding. I mean, they reinstated,
title?
they reinstated me the next day, and then I said, no, piss off. But that's our industry. That is literally like the brokerage industry, and it drives me balmy. I just yeah, I can't.
This is good, mate. That's why we've got you on a rant, right? Because I know you like to go off with it, because I listen to your podcast as well. So while we've got you in flow here, what are your common like bugbearers about, you know, property investors like us, you know, coming to you guys, you know, and obviously you hear all the jargon, you know, maybe fresh out the courses, that sort of thing. You know, what is the kind of common bugbearers?
You know what? I actually don't have that many bugbears about investors. I think that a lot of people come to me wanting to learn, and I think that's a really, really good thing. I think that if you are an investor, you should be looking to your lettings agents, your brokers, your accountants, you know, solicitors, whoever it might be, mentors, and going with a real open mind and understanding that these people are there to advise you, and you've got to have a trust with these people. I suppose my only bugbear is if I have a client that, I mean, I do get it occasionally, that will come to me and like dictate to me what's gonna happen, and I'm kind of like, well, you've come to me for help and advice. Why don't you just take my help and advice? And I think in the last couple of years, I've probably said to, I think 3 clients I can think of that we've since we started Grand Union Finance, 3 clients that after the first transaction that we've done, I've kind of turned around to them and said, look, I'll be honest with you, I don't think I'm the right broker for you. I think you kind of want a yes man, and I'm not a yes man. I'm a yes, let's get going man. But I'll give you my honest opinion of how we should be structuring certain things, what type of finance we need to be doing. And I don't hold back. I'm very honest with my clients, because I say to them, look, there are 1,000, actually there's 8,000 brokers registered in the UK, but there's thousands of brokers out there. You can go and use any one of them, and quite a lot of them have probably maybe got a similar knowledge level to me, but they can at least do the transactions. You know, they will be able to do a mortgage application, they will be able to do a bridging application. But where I try and sort of differentiate myself is I say to my clients, look, my job, yeah, on a transactional basis, we've got to find the right products, etc. But it's bigger than that. It's overarching. My job is to make you successful.
Is that kind of thing, like, meaning like if a client was coming to you looking for a bridging loan, and you knew that you'd want to make sure they had a guaranteed exit before they went onto an expensive, potentially binding, you know, product that they might not necessarily get off of? Because I've heard people kind of bitching and moaning about brokers and, oh yeah, you know, I can't get this bridging loan, and I'm like, but did they line up your exit finance? Because if they don't exit your finance, why would somebody want to put through a bridging loan for you? They're looking at it for your best interest, surely.
Look, and this comes back to what I was saying earlier on about the industry. I know that there's brokers out there that will take the bridge. They'll just go for it. And whether there's an exit or not, they're going, quick win, you know, quick win, bit of money in the bank, happy days. There's 2 things wrong with that, in my humble opinion, which is, number one, the obvious one, you don't want to trap somebody in an expensive, relatively expensive finance product that's not conducive to a long-term relationship. Whenever I speak to a client for the first time, my goal is that they're going to be lifetime members of the Grand Union fan club. You know, that's what I'm trying to do. If we just earn some quick dollar off them early doors, what's the point? You know, there's no point in that. Secondly, though, as well, and this is where I think a lot of brokers just completely forget how important this is. The reputation that you have with lenders then goes absolutely, you know, down the pan. When I send over I had a new starter join us recently as a broker, and she's worked for like one of my competitors, and she was looped in on the emails when I was sort of sending out funding proposals on a bridging loan, and she was like, Jesus, the level of detail you put in that just on an initial inquiry, and it all starts with that exit. It all, you know, I talk about that exit in the proposal. You know, we're going to refinance. What's it going to be worth? We want to get 75%. How much is that going to be? Are we going to be able to get that because of the rent and the rental calculators, etc.? That's the first thing I'm talking about. And that should be the first thing that whenever you're talking about bridging, that should be the first thing that you're talking about is, how are you getting out? Because funnily enough, that's what the lender's thinking. How are we getting our money back? That's all they care about.
Yeah. Let's get into some of the nitty gritty then. bridging loans, we'll just take it back to a basic level. I think, for our listeners, a lot of people will be just starting out and looking at this. We've certainly had a lot of questions from our listeners in the past, Stephen, and this will be a perfect podcast just to direct them to, just so they can get the kind of most commonly asked questions answered. So, Sam, do you just want to kick us off with exactly, what is a bridging loan? Just give us a summary.
Yeah, I mean, look, for all intents and purposes, a bridging loan is just a short-term property finance loan. It's there to bridge a gap, hence the name. So it's actually pretty similar to a mortgage in very, very many ways. If we're just talking in simplistic terms, we're not getting into some of the little variations and different types of bridging products. We can talk about that later. But, if we're talking property value, maximum loan to value is exactly the same in that regard. Typically 75% is where we're going to be. That it's based on the value of the property. Now, the big difference obviously comes in terms of how long you've got it for. So your interest rate isn't necessarily going to be an annual interest rate. It's going to be a monthly interest rate. Most lenders as well, because of the fact that the property is not going to be sort of rented out straight away, they can't, like a buy-to-let lender, fall back on the rental income so that they can feel comfortable that the monthly payments are going to get paid. So they will either do an affordability assessment on you, not as vigorous as you would get with a residential mortgage, but they will still do an affordability assessment on you. Or, and this is the way that most lenders like to do it, is that instead of making you make a monthly payment of the interest, they'll actually deduct the interest from the loan at source. And what I mean by that is that if we're borrowing 75%, they will work out how much, based on the monthly interest, how much the interest on that amount would be on a monthly basis, times that by 9 or 12. They typically are the two sort of term lengths that we go for. And whatever that figure is will be deducted from that 75%. So when we factor in the lender's fees, which will also be deducted, what people then don't realize is they say, oh, well, I need 25% deposit. Well, actually, if you're going for a 75% loan to value bridge versus a 75% loan to value mortgage, you'll pay 25% on the mortgage, but you're probably going to end up paying something more along the lines of 30 to 35% on the bridging loan. So that's just something that needs to be, that people need to just take into account, is that you're probably going to have to put more in day one. The difference is obviously that you're using that for a particular reason. You're probably doing a refurbishment. A lot of my clients do conversions, so they might be doing like a residential to an HMO, and they'll use that bridging loan to acquire that property. And we know that we're going to be refinancing out on it. So they'll kind of make their money back, if you like, on, they have to put a little bit more in, but they're going to be getting, a large chunk of that back out at the other end.
So what are the common uses of bridging loans in, Sam?
It's a lot of the time it's acquisition. I have done a few remortgage bridges, but generally it's to acquire a property very, very quickly. One thing I will say in terms of the speed, by the way, is you see and again, it's just, I don't know if I'm allowed to swear on this podcast.
Go for it, mate. Let yourself go.
The bullshit that I see just out there just drives me nuts. When you see it advertised, particularly, this is what makes me laugh even more. I see it in industry magazines, right? So our own industry are bullshitting themselves about how quick bridging is. It's like, we know how quick a bridge is. It's 2 to 3 weeks is a really good quality quick bridge, right? And then you see people did a bridge in 4 days. Did you actually do the bridge in 4 days?
Is that bullshit, is it?
Right. Well, the conveyancing fucking process can't be done in 4 days, is it? Or they won't do it.
So this is it. So I actually, somebody posted a story on LinkedIn. It was like, it was from like an industry magazine, posted it on LinkedIn. Another broker. Was it another broker? It might have been the lender. We did this bridge in 4 days, 5 days, whatever it might be. And underneath I said, that's amazing. So did you manage to get the valuation and all the conveyancing done and the underwriting all done in such a short space of time? Underneath they went, oh no, well, they actually came to us because they'd failed with the bridge before, because the lender decided not to lend. So we already had their valuation and all the legals was already done. I said, so you didn't do a full bridging application, did you? You just piggybacked somebody else's, and that's why it only took 4 days. In fact, why did it take you 4 days? Did it take you 4 days to move the money? That's not very good. Should have taken you 2. That's ridiculous. Why are you bragging about this? So it's crap like that. You see that all the time. If anyone says they've done a bridge in less than 2 weeks, I can absolutely guarantee you part of the process has already been done prior to that happening, or the loan to value was so low, like 50%, that the lenders just basically gone, you know, this is so de-risked that we don't have to do a valuation on it, or we can basically indemnify everything on the legals, and that's how they get it done so quickly. So there are ways and means, and I'm certain individual lenders have done bridging applications in those times, but there are always mitigating circumstances that have allowed them to do that. So I think for the Joe blogs on the street, maybe reading that and going, and then when they come to me and they're saying, oh, so can I get it done in a week? No, you can't. You want to borrow 85% on a bridge, and you want it done in a week. It ain't happening, mate. I'm really sorry. I'd rather just tell you the truth. It's funny, I actually had this recently. Today I found out that it wasn't going ahead. We had a client that bought a property at auction on Wednesday last week. Came to us on Thursday. First mistake: speak to your broker before you go to the auction. People, come on. But anyway, and he said HMO conversion. He said, right, I'm doing an HMO conversion. I need development finance for it. I said, and when's the cut-off day? He said 20th of June. I went, so you want us to do? Bearing in mind we've got like a 4-day bank holiday coming up. I was like, so basically we've got 3 weeks to do development finance. He said, yeah. I said, like, that's not happening. I'm just being honest with you. It's not going to happen. We're going to have to bridge this, and then we're going to have to figure out the development finance, as part of that process, and we'll kind of almost remortgage onto development finance type thing. And he was like, okay, I'll think about that. He's come back today, said, oh yeah, no, I've spoken to another broker, and he said he can get me the development finance in 3 weeks. And I said, cool, I'll see you in 2 when he tells you it's not going to get done in time, and you need your 1 week bridge. Well, to be honest, hopefully by then some of the legals will be done, and the valuation will be sorted. So I should be able to do it in a week. No worries. He'll just have to pay 1% a month rather than the 0.7 or something that he would have paid normally. But yeah.
And are you finding, like, I mean, I don't know about you. I mean, obviously you're dealing with it day to day, so you'll know exactly. But for me, like, I found things, post-pandemic or post-COVID, I found them like a lot more slower and just getting normal, just buy-to-let company mortgages through. I don't know if you're having that problem as well.
Yeah, massively. I am coming across like I'm moaning a lot on this, by the way. I'm actually quite a happy person.
Let's spread it. We'll come on to positivity.
Listen to this miserable southerner talking about mortgages and bridging.
But we need to face realities as well. People know that it's not easy. You know what I mean? That's why we got you on as well. You're not trying to sell a course here. So
no, but if you do want to jump on my course, it's 997 for a limited time only. So this is the reason why buy-to-let mortgages are taking longer at the moment. It's really simple. We've had 3 increases in the Bank of England base rate in 4 months, and what that's led to is that lenders, for the first time in over a decade, are en masse withdrawing products from their product range, and everyone knows that they're being withdrawn to be replaced with more expensive products. So what happens is lenders will sort of ping out their emails to their brokers going, right, okay, our products are going to be withdrawn in 48 hours. You need to have fully submitted your application within that time period in order to secure that rate. So guess what's happening? You're getting 3 weeks worth of mortgage applications for that lender coming in a 2-day period. Of course, the knock-on effect of that is it's going to have an impact negatively on their service levels, and that's to be expected. What's actually started to happen, which I mean, I kind of understand why they're doing it, is we're starting to see, the normal time frame would be, right, we're giving you 3 days notice, 2 days notice. The other day, Barclays gave us an hour and a half's notice. So let's say you're a broker and you've done all your research for a client. Barclays have come up best. You go back to them, Mr. Client, here's, I recommend this mortgage for you. It's with Barclays. I must admit, I don't do a lot with Barclays because I don't do a lot of residential mortgages, but just for the purposes of the example, here's your mortgage, this is what you should be doing, here's an illustration. And then you've got like a few little things that you need to sort out. Like, the client's got to give you instructions, go ahead, usually by signing, like, we've got terms of business that we get them to sign. And we're probably going to need to see some documents up front just to check, that all the information they've given us is correct. Because otherwise, what's the point in submitting an application that's never going to go ahead? You're never going to do that in an hour and a half.
Yeah.
So you've just done all this research and it's wasted. You've got to start it from scratch. So my biggest issue at the moment, in terms of, and look, I'm not alone, so if anyone's listening to this that's getting a bit annoyed with their broker at the moment, keep telling them that rates are changing. It's not our fault, honestly. We're all suffering. I've got a client at the moment, I've had to do their research 3 or 4 times now. And what's even more annoying, this is literally what's happened last night. I was in the office last night at 7:30 in the evening, just sort of finishing up a few bits and pieces, and I get and I was texting one of my business development managers for a lender called Precise, and was saying, I'm just going to sort out stuff. I've got an application that I'm going to be putting in tomorrow. Can I just clarify something with you? Just WhatsApping her, and she come back and she said, you do realise that we're putting our rates at 8 o'clock tonight? And I went, but you said you're pulling them on Tuesday. She says, no, we're launching new products on Tuesday. And I said, well, read your WhatsApp. That's not what you told me. So I've gone back to the client today, made a recommendation on your product. And now I've got to go back to them and go, so actually, that's not available anymore. Here's the next best one. And it makes us as brokers look unprofessional, but there isn't really anything we can do. It's really, really frustrating. And it just adds to our workload, and we're busy already.
Once you've got the application logged in, Sam, how long does the lender hold that application before it goes to completion, before they kind of pull it? Because obviously the rates have changed.
So I can only think of one lender that's recently come back to us and said that effectively you've got to complete an application within a certain period of time to secure that rate, which was Aldermore. And I did go back to them and say, that's BS, boys. Like, once you've there you go. So get that done quick.
7 months ongoing.
Oh man, well, you might not have that rate for much longer. But most lenders, once you've submitted the full application, because if you think about it, so it all goes back to the way that that mortgages are actually arranged, or how lenders arrange their products, which is every single product has a funding line attached to it. So one lender might have like several funding lines, and I'm not saying that every individual product has a completely different funding line, but let's say they've borrowed. Let's be honest. So most lenders in the country borrow their money from RBS, which is why the Bank of England and the government had to bail out RBS back in the credit crunch, because if they didn't, it would have been absolute chaos. So yeah, all those people got paid hundreds of thousands of pounds in bonuses, but trust me, it would have been a shit ton worse if they hadn't have bailed them out, because most of the country, as I said, first tier lending, interbanking lending, it comes from RBS. So much of it does. So one lender, like, I don't know, Shawbrook, commercial lender, will say, right, RBS, can we borrow off of you, £20 million for this product? They go, yeah, no worries, and they organise a price. That price is then fixed. So if the Bank of England puts their base rate up, it's fixed. That they've got that pool of cash, and then what they do is they'll lend out all that money, and then once it's gone, they'll then decide to change the rate. So when you apply for the mortgage, that money is then allocated to your application. So that's why generally you secure that rate once you've submitted that full application. That's kind of the mechanics of it, if you like.
Interesting. That's interesting because you don't really see that, what goes on behind the scenes and where the money's come from and all that. So that was really good.
There were very, very, very few lenders, particularly bridging lenders, lend their own money. I was actually speaking to a bridging lender. I get contacted by bridging lenders all the time. We've just been longlisted for a bridging award, and so I'm getting loads and loads of emails now from like bridging lenders that I've never heard of, going, use us, our UPS is speed. It's like, oh, is it really? Okay, great.
That's all I seem to get on LinkedIn all the time. All my LinkedIn messages are you needing lending for this development here?
I am actually, yeah. But everything you're offering me, I can get from about 17 other lenders. So I'm quite brutal with bridging lenders, and the reason I'm brutal with them, and I'm brutal in a nice way, if there is such a thing, but I'll say to them, look, I'm just giving you feedback, guys. You've just sent me a message that says, we are a new bridging lender. We would like to create a relationship with you. Our USPs are, we're very quick. Okay. This is our pricing. Okay. It's the same as every other lender in the market. Yeah, I had it recently. Oh, we do dual representation on our legals. Yes, so does 70% of the market. And I went back to a lender recently and I said, right, I'm calling you not because I'm going to use you. I'm calling you to tell you to up your game because you're coming to me and saying, use us, but you're not giving me any reason to. I said, you've got to create a genuine USP. Another bridging lender came to me a couple of months ago, said, "Hi Sam, look, I'm not going to tell you that we're the quickest. We are, but you're only going to do the proofs in the pudding. You're going to have to see that for yourself. We do this in our underwriting, which I know most other bridging lenders do, but I'm just telling you, we do it too. We do the dual representation, legals, blah blah blah, all this kind of stuff. We've also got a product that we think is pretty unique in the market. It's a split product. You pay a lower amount of interest on the first 6 months and a higher amount of interest on the latter 6 months. There's no minimum term. So your client could conceivably, if they refinance out before 6 months, only pay 0.5% on their 75% loan to value bridge. That is a cracking product, and I can use that. So that is how bridging lenders should be approaching brokers, with something that they don't already have. And I say to people all the time, as a brokerage, there's no lender in the country that won't work with us. We're completely unrestricted. We're not working to a panel. But do I use every lender in the country? No. Do I think of every lender in the country? No. I have got bridging lenders, development lenders, commercial lenders that fit different descriptions of different clients and offer different things. And I know I can go, right, I've got a first time developer wants to borrow maximum. Right, here's my little group of bridging lenders and development lenders that I trust can do the job right, price efficiently and accordingly to the rest of the market. And I've used them previously, so I know their process. There might be 25 other lenders that do exactly that thing and would give me just as good a service. But why would I use them if I haven't used them previously when I can get that from a lender that I'm already using? And this is why, you'll go to one broker versus another broker, and they'll give you really, really similar terms from completely different lenders. And it's not because one's better than the other. It's just because those individual brokers have got those relationships with that. So it comes almost a little bit full circle to what you were talking about earlier, Nick, in terms of what is my kind of bugbear, if you like, a little bit of certain investors is, trust your broker. If I'm saying, this is the best thing to do, going and getting a second opinion, and actually it can be quite dangerous to get a second opinion in the bridging world, because bridging lenders, if they see a deal more than once, number one, if I go to a lender and say, right, here's my proposal, they may come back and go, we've already had it from another broker, so if they want to use us, they have to use that other broker. Well, to be honest, that doesn't necessarily happen as much anymore, I think, just because the lenders that I use tend to favour me, but that's just because I've been doing it to a decent standard for a long enough period of time. But some lenders will just go, okay, this is just being chucked around the market. We're not interested.
This would be like if it was like a bigger development or something like that, or but just for our bread and butter stuff, like, because a lot of our listeners will be thinking about doing bridge and lending for, buy, renovate, refinance, because we don't really do like HMO conversions up here in Scotland and stuff like that.
They're common for flips. I use bridge and lending a lot for flips in Scotland. Like they're quite flexible.
Yeah. So for that sort of thing, do you have like any kind of go-to, good solid bridge and finance lenders that you would just regularly be like, this would be the one that I would use,
Yeah. So when I'm thinking about which lenders to use for a particular project, let's say it is a flip. I'm thinking about a few different things, which is, so I've got this thing I call the bridging triangle, which is each point of the triangle represents pricing, flexibility, and speed. So there are priorities, right? Which of those is the most important? Obviously, if you're buying at auction, speed's the most important. So you've got to go to a lender that is going to be able to do it in the time frame. If you need to borrow a lot, so let's say you want to do a refurbishment bridge, so you're borrowing 85% loan to value. If you wanted to do an open market value bridge where the lender's happy to lend based on the open market, if you're buying and the purchase price is less. If you just need to stretch the loan to value to 75%, to be honest with you, flexibility is pretty high up there, because most bridging lenders will cap off at 70%. Then flexibility is your most important. Only when speed and flexibility are not your priorities can you then go for pricing. And I do have clients that do come to me and say, look, there's no time constraints, so I need to borrow 70%. I go, great, let's go to the open market and let's get the cheapest we possibly can. But that's where you kind of then categorize. And the thing is as well, Nick and Stephen, it changes so often. So for example, most of last year, if anyone came to me and said, oh, I need a really quick bridge, there were two lenders that I was pretty much using all the time, and one of those lenders has slowed down a bit recently. Like I've just noticed that they've been slower, and as a result, I've kind of gone, okay, that last one wasn't quite as slick as it was previously. Let's talk to this, a couple of other lenders about this and ask them about what their turnaround times are for certain things. And I'm going, okay, well, they seem to be turning things around quicker. So then they jump up the league table, if you like, to being sort of in the the top couple of
places. Come on, give us some names of the ones that you like to use at the moment then that are some of your favorites.
I can reel them off. So MT Finance, really, really good lender. Funding 365, amazing. Shawbrook are slow but good quality products. Underwriting's a bit pernickety, but there we go. Lend Investor are a really good lender if you've got the right loan amount. So they don't really want to lend less than 100,000. That's the same with a lot of bridging lenders, by the way. Minimum loan sizes are really key.
That's a good point, actually. We'll just pause you there because, like, obviously we do have quite much cheaper property up in some of the areas around about, Scotland where we're based. So, like, what is that kind of usually a rough guide to the minimum sort of lending requirement?
Yeah, so I mean, I'm doing two bridges for a client simultaneously at the moment, both with Shawbrook actually, that are there. So they're one of a few lenders that do the refurbishment bridge product, which essentially means you can borrow 85%, and theoretically the 75% is the max, and the extra 10 is to go towards the refurbishment. So the refurbishment has to be more than 10% of the value of the property, if that makes sense. But they are really small. They're not in Scotland, but they are. One is, I think the purchase price is 51, and the purchase price is 59. So they're one of a few lenders that will go quite low. But you know what? Like with Shawbrook, with a lot of commercial lenders, you have got to nail their process. Otherwise, you're going to be sitting on that for months. A lot of the commercial lenders really rely on brokers knowing exactly how their process works. And a lot of them have closed panels as well. So if you're a new broker, you might not actually be able to jump on panel with them unless you can prove that you know what you're talking about, which you can't because you haven't been put on panel. So it's a bit difficult. But yeah, a lot of these lenders, you have to understand their process. Otherwise, you're just going to be sitting and underwriting for months. But yeah, so you can get lower value bridges. And to be honest, I always say to my clients, like, I don't have a minimum. I have to be commercially viable, and I have to look at every case on its merits. I mean, I said to a client recently, they needed it done really, really quickly. It was very, very complicated, and it wasn't really the highest loan I've ever done in my life. And I kind of turned around to him and I said, look, if I charge my standard fee structure, this is how much I'm going to earn off this. If you consider how much effort and time and everything's going to go into it, I'm basically losing money. So I'm happy to do this for you, but I will have to charge you slightly more. And they understood, and we did it. And we kind of split the difference on it, and I said, look, you're a good client, and I want to be able to help you out. But it's a lot of work for not a lot of money. So I have to take that into account. But yeah, I don't really have a minimum, don't have a maximum. We're working on stuff, like I said, that's 30, 40, 50 grand bridges, and I've got other stuff in the pipeline that's several million. So it's kind of everything in between, basically.
See, for the guys that are starting out, could you give kind of rough price examples if they were just to go and get like a bridge for 100 grand flip, say, for just a purchase price? Like, what would be the costs associated with it, deposit required, arrangement exits, kind of normal percentages, legals, all that kind of shit?
Yeah. So I always say to clients, look, at the moment, obviously this might change with further base rate increases, but in terms of interest rates, match your interest rate to your loan to value. That will give you a really nice rough guide. You're probably going to end up getting slightly cheaper, but if you're borrowing 75%, work out that your monthly interest is going to be 0.75%. You're probably going to be able to get cheaper, but at least if you're working it out on those figures, any improvement on that is better. Standard lenders, 2% fee. They'll deduct that from the loan. Now, the tricky bit
is 2% of the purchase of the loan, sorry.
Of the loan amount, yeah. That's pretty much standard. there's other fees that are involved, that it's good that Stephen's brought this up, because they are quite different sometimes from a mortgage. So valuation, you always need a valuation. However, it's probably going to cost a little bit more. And there is actually a reason for that. The bridging lender is going to be asking for more information than just a standard, valuation for mortgage purposes. So they're going to be asking for not only the open market value now, they're going to be asking potentially what it would be worth once the work has been completed. And they're also going to be asking for something called a 180 and a 90-day valuation, which is essentially, if you limited your marketing on a property, would it have an impact on the value? Because actually a lot of bridging lenders, and this is something that is not talked about and is missed quite a lot, is that most bridging lenders will lend off the 180-day valuation. So if they were limited to 6 months marketing, what would the price be? Is there actually going to be any difference? And at the moment, I'm finding there is probably a slight difference, maybe a sort of like 3 to 5% difference in those two. So that's something to be wary of as well. So valuations, I would say, typically are going to cost you maybe 10 to 20% more than a mortgage valuation would do for the same property. Legals. Now, you'll probably know this already, Stephen, but if you're buying with a bridge, you can't just go to your standard conveyancer for legals. You've got to use a commercial specialist. They're going to charge you more, potentially double what you're paying, your standard conveyancer. Have both in your team, because when you come to your remortgage, you don't want to be using the expensive commercial conveyancer, and they'll understand that as well. But
and you've got to pay the lender's legal fees as well.
Yeah, you've got to make a contribution. There's actually, and again, there's method to the madness, because when you, and this is, I guess this goes back to like the bridging 101, which is in terms of the process itself. All the elements to a mortgage application exist in a bridging application. You've got your underwriting, you've got your valuation, you've got your offer, you've got your legals. The difference is that a lot of them happen all simultaneously. So as a result, the for want of a better phrase, the penetration rate, so i.e. the sort of the success rate, if you like, that's a nice way of putting it, isn't it? Hopefully no one's listening to this early in the morning with the kids in the car. But the success rate isn't as high, and it's not because bridging isn't safe or isn't a very good type of loan. It's just purely because there's a few things that could happen that could kick it out of bed during the course of the application, namely a valuation. So when I'm submitting a bridging application, I'm asking that valuation to be instructed day one. I want to get that done within 24 hours. Whilst they're just doing their initial underwriting, I mean, they've kind of already underwritten it because I've already told them what's what. I'm just sending them stuff that proves what I'm saying is true. So they're just checking that. We get the valuation done, and usually shortly after that, we instruct legals as well. Now, for the legal inquiries, for the list of stuff that your solicitor's going to have to do to be sent to them by the lender solicitors, the lender solicitor has to know that they're going to get paid for that. And so that happens generally by way of what we call a legal undertaking. And what that means is that your solicitor will have to write to the lender solicitor to say, right, you have asked us for £1,982 to be, to cover your initial legal fees. And I can confirm that we have this in our account. It's been set aside, and I'm sending this to you as an undertaking for your costs. So they don't send it to them. Your solicitor just has it on file. Some lenders will just ask for a fee to be paid directly to them, and sometimes that's done right at the very beginning of the process. But most of the time, it's an undertaking. And what it means, and the reason they do this is because in theory, a bridging lender could start, let's say, 100 applications, and every single one of them could fall out of bed, and they are then left with 100 legal bills. Well, that's not really fair, because there's a load of reasons why that doesn't go ahead. That is not the lender's fault. Potentially, they've agreed to do a deal, and this is where it comes back to, again, sorry, brokers that are listening, I'm going to give you a hammer in. Brokers not doing a good enough job day one in actually talking the lender through the deal. And then what happens is you see a lot of brokers complain, particularly on LinkedIn, are bridging lenders. They change the terms halfway through the deal. Well, why did they do that? Is it because you didn't give them all the information up front, and they've looked at it again once you presented everything to them and gone, actually, this is a bit more high risk than we first thought? That's 95% of the time the reason why a rate is changed. So it's actually the broker's fault. And I get hammered for saying that all the time. I don't have any broker friends anymore.
I'm surprised.
Surprised anyone wants to come and work for me. But I'm just giving the honest truth. And to be honest, lenders back me up on this. So where was I going with this? So there's loads of things that can happen throughout the process that would mean that it doesn't actually end up completing. And obviously it's unfair for a lender to then be just lumped with a massive legal bill through no fault of their own. They're a business themselves at the end of the day. And that's why they asked for it up front.
Yeah, that was the legal fees. Any other fees after that?
I'm trying to think.
What about your fee? How much do you charge?
I always charge my clients $495 once we submit an application. Just again, that's similar to the lender's legal fees. So we know that there might be something. To be honest, mainly it's just if the valuation's a complete disaster and we can't go ahead, or maybe even the vendor pulls out. We need to just cover our upfront costs and make sure I'm not going to be able to run a good quality business on 495 application fees. We do charge 1% of the loan amount, which gets deducted from the loan at completion. So effectively a success fee. We're only getting that if we actually make it all the way through, but we've got to cover our costs as well. I had a client recently come back to me, and again, people might listen to this and go, well, that doesn't sound very, very good. I'm not going to use you, Sam. Well, fair enough. But I had a client, we did a mortgage application for them, a remortgage. And this is one of the few times, I'll be honest with you, that I've gone back to a client sort of during the course of the application, because we got the valuation report back, and the valuation report was not very good. As in, the report was fine. What it said in the report was not good. The property was dreadful. It was the wrong area. It was on a road that was predominantly commercial. It was next to a huge pub on a main road. It was as if you had two properties and there was a little gap in between that once upon a time you would drive there because there was like a car park at the back or something, and they'd wedged a little house in there. And the valuers just come back and gone, this is a really shit house. like just don't lend on it. And I kind of went back to him and I just said, look, this isn't great. If you want my honest opinion, I think you should sell it. I think you should just get rid of it. I don't think it's worth, trying to, and they were adamant it was worth a certain amount of money. I'm like, but you're basing this on another property down the road that's, much, much better than yours. And so the lender agreed to lend, just not when the valuation report came back, which we had we could never envisage that the valuation report was going to be that damning. I warned him before. I said, look, I think this is going to be a difficult property. It's not the best, but also at the same time, you don't want to be like having a go at an investor. Yeah, you've chosen a really crap project here, mate. It's not what they want.
All the red flags for lending, isn't it? Like the commercial and what I mean. It's like the pop.
Exactly. And I made the client aware of these, and I did actually. I actually sent details of the property to the lender prior to submitting the application to say, is this something? So lenders have this terminology. It's like their get out of jail free card. They'll go, yeah, we can consider it. That's their terminology. Yes, this is a case we can consider. What it means is this meets all our criteria. So probably going to lend on it, but they'll only say consider is their get out of jail free card. So you can't go back to them and say, you told me you definitely lend on this. So they came back and said, yeah, we can consider this property. It's within criteria, subject to valuer's comments. That's their second get out of jail free card. So it's the underwriting passed. The client had some quite tricky circumstances. Underwriting was passed. We managed to find the right lender at a really good pricing at the time. And I did say that, the valuation is going to be, this whole thing's going to be based on the valuation. As I said, came back, absolute disaster. Clients come to me and said, okay, well, I want you to speak to the lender and I want a refund of all my fees. And I said, well, we're not going to get a refund of the valuation fee because the valuation took place. It's not the valuer's fault that the property wasn't deemed to be a suitable security. I went, okay. He said, well, what about the upfront lender fees? So this particular lender charged the £125 application fee, which I made him aware of at the beginning. I said, look, this is not going to be refundable. I said, well, it's not refundable. It passed it. It passed underwriting. So, if they screwed up because we submitted on false pretenses, then I've had those refunded previously. And he goes, well, what about your fee then, Sam? And I said, so hang on a second. So I've done my job, but you want me to give you the money back. So you want me to have worked for free? And he was like, well, no, that's not fair. I said, no, it's not fair. I'm really sorry. And I even said to him, I said, look, if you do think I should work for free, then maybe you need to find a different broker, because that's not how we work. My clients, respect my time and really want to work with me. And I'm so lucky. I am absolutely so lucky because I've got like the best clients in the world. And we work really well together. They WhatsApp me when they've got deals to go. Just had an offer accepted. Here's all the information you need. Can you just let me know? And that's the kind of relationships that we have, and that's the kind of relationships I want. And straight away for him to turn around and say that, my instant reaction was kind of like, "You're taking the piss, mate. That's not fair." Why should everyone else?
Why should you suffer because he can't do his job right and find the right property to do?
Yeah, do you know what I mean? Yeah, that's exactly what it was. And I mean, even when I'm saying it out loud, I'm still thinking, "Sam, you sound like a dick." But it's hard because the easiest thing to do is to bend over backwards and just go, yeah. I'll do whatever you want.
You're trying to run a business, mate. You've got to draw the line somewhere. So
I know.
I mean, like, talking about the I'm interested as somebody who's never done a bridging loan before, just getting back to the application stage, and how much do they go into looking at me as an individual? Like, do they, if I'm wanting to invest through a limited company or something like that, is that, do they look for personal guarantee, like, normal buy to let, do they look for income, accounts? What sort of stuff are they asking for?
Yeah, so good question. Hopefully throughout this podcast, I've kind of proven that I don't really sugarcoat things. So let's continue in that vein, that people buy properties in limited companies for tax purposes. Let's not pretend it's for any other reason. The term limited company is outdated. There's nothing limited about it. Your liability is not being limited at all. This is a terminology. I mean, did you know the word mortgage actually in Latin means till death? But no one has a mortgage till death. Well, very few people have a mortgage till death. It's just a terminology. Yeah, some people do. But so it's the same with a limited liability company. It's not limiting your liability. To be quite honest with you, I've actually submitted, believe this or not, I've submitted bridging applications. And in the section where it says company details, I've put TBC because the client hasn't actually set the company up yet. It's an SPV. We know what it is. We know what the shareholding is going to be. These are generally with clients I have a bit of trust levels with. I wouldn't necessarily maybe just do that with a brand new client, but the limited company, for all intents and purposes, the lender's not that bothered about it. They're interested in you because you are the UBO. You're the ultimate beneficiary owner of that property. Yeah. It's you that's ultimately responsible for the loan. And I get clients all the time saying, "Oh, why have I got to sign a personal guarantee?" I said, because you should be personally liable for this loan. If you don't sign a personal guarantee, you're basically putting all the risk of everything that you're doing on the lender. And why should they have to take the risk? They're already taking a bigger risk than you in terms of they've got more skin in the game than you have. Yeah. If they're lending you 75% of the value of the property, they've got more skin in the game than you have. If it goes wrong, they stand to lose more than you do.
So, at what level do you get to with lenders where they don't require a personal guarantee? Like, is it a loan to value, or is it a amount, or is it your net worth?
It tends to be a little bit with that. I think relationship comes into a part of that as well. There are certain lenders that you don't have to necessarily do 100% personal guarantee. So it might be 25% personal guarantee or something like that, which basically means that you're giving a guarantee for up to 25% of the value of the loan that you've got. So if you did default on it, they could only come after you for that kind of level, which, I mean, to be honest with you as well, the personal guarantee, this is why, again, I mean, I'm making it out like I get kicked back on this all the time. I don't. Most clients just go, yeah, cool, no, I understand that. If you're borrowing 75% of a property, the value of that property has got to go down quite considerably for you not to be able to, for the lender, should they need to repossess you, not be able to get their money back from, selling that property at auction or something, which is probably what they would do.
You've really got to have fucked up to be liable personally for it.
Exactly. And I'm not being funny, but if you have fucked up, then you should be liable for it, surely. It's that's kind of how it works. In 15 years of doing this job, I've only lost one client because they refused to sign a personal guarantee, and I was just like, look, for what you want to do, there's no way in hell you're getting the lending you want.
My solicitor sums it up quite good. Every time I go in and see her, she looks at me in the eye, she goes, Usual applies. She says, I advise you not to sign this, but if you don't sign it, then you won't get the money. So it's as simple as that, isn't it?
It's even, I even find it peculiar that a solicitor would say, I advise you not to sign it. Like, why would they not advise you to sign it? They're basically saying to you, yeah, do you know what? You should let the lender take all the rap for this. Yeah, that doesn't. Yeah, it doesn't.
I think that's just covering their arse as well, isn't it?
I mean, 100%.
See with the bridging lenders, like sometimes I'll ask for like a floating charge over the asset. Is that a common thing for bridging lenders to ask for this bond of floating charge, or is it quite specific?
If you it depends on the deal, but so there's different sort of variations of what that can mean. So sometimes they might do something like a debenture over the property company, as well as like an added charge. Funnily enough, I had this recently with like when I say one of my best clients, I don't like kind of keep a league table or anything, but she's like a astronomically brilliant investor, and she came back to me. We had a situation like this once where we're doing a remortgage. She said, "Oh, my solicitor said that they need a debenture over the company. I've never had one of those before." And I said, really? Because your solicitor's just come back and said one of the reasons why it's going to be difficult is because there's already a debenture on there. And she went, is there? I went, yeah. I mean, you would have signed for this, like with this other mortgage that you did with, on your own like years ago. She's like, oh, didn't even know about that. So that's something that sometimes lenders do to give themselves some extra comfort. A floating charge in certain instances. So if you think of it in terms of first charge, second charge, and then over and above that, you can have different lenders call it different things: tertiary charge, comfort charge, floating charge. And these are generally kind of not, they are binding, but they're a bit more flimsy. It's not a first charge over a property. So what you might have is the instances where we've maybe used this before is where you've got, say a client's got like a portfolio and it's leveraged at say at about 60% loan to value across the portfolio. They're buying a new property. They want to borrow, that little bit more than what the standard loan to value would be on that particular deal. And so the lender will go, well, look, we'll take a sort of floating cover charge on part of the portfolio as well. It's just like a little bit of an added comfort to our loan. So if they go pear-shaped, they can help.
I found them very often when you go a new bridging lender, they'll ask for it, but I always kind of feel like what the fuck? Like, you're asking for a standard security in the property, you're asking for you've got security on it, you're asking me for a personal guarantee. Like, why would you want a floating charge over the whole company as well? And one of them, they were just like, with Point Bank refused with LendInvest last week. There's like 30 odd properties in the company. We're buying 5 flats with like a loan to value, and we're going a little bit higher, like you say, you need a bond of floating charge. No, you're fucking not getting a bond of floating charge. You can have security over 30 other assets for one loan. Like,
yeah,
it made no sense. But they were like, oh no, that's our standard practice. I'm like, well, think about it. Like, we're not going to give you security over it.
Yeah,
Stephen, they'll be wanting a charge over your new Porsche soon. That'll be the next thing.
I'll have to wait till I fully own it.
They take your kids down to the bridging dungeon. They keep them there until you pay them back as well. Yeah,
it's nuts. But like, I find bridging, I don't know, like you personally, maybe a good point to the listeners is they're pretty flexible. They're not as kind of stringent as here's the terms, here's the conditions. Like, they're quite flexible in the relationship, and they might ask for all this up front for the first time you deal with them, but the second time you can negotiate that a little bit better, a little bit more loan to value, a little bit better rate, because it's more a personal relationship. Is that fair to say?
Absolutely. And the thing is with this as well, so there's 2 schools of thought here, and I think both of them are actually really viable, really, really important. Is that, so the first is you go to one bridging lender and you just keep using them time and time again, and it's going to be easier and easier and easier and easier. However, and this is where I think the role of a broker becomes quite important, is that one bridging lender was brilliant for that particular deal that you did. Doesn't mean that they're going to be brilliant on the next deal. They might be good, they might be okay, but they might not be the absolute best. So you can go down the route of going, do you know what, I'm going to build a relationship with 1, maybe 2 bridging lenders, and I'm just going to keep using them time and time again. Happy days. Or I'm going to, every single time we do this, it might be that we end up, building those relationships with various lenders over the course of a period of time. But I've got a client, we're on to, he buys a lot of property. We're on to about the 10th bridging loan so far this year already. And I think every single one of them's been with a different lender. because it's all down to what the circumstances for that particular property are, what their circumstances are at the time. Some bridging lenders aren't really keen if you've got like loads of other bridging loans out already. So every single time you've got to take that into account. So in my mind, and this is why I say to people talk to me about bridge to let products, for example, quite a lot, and they go, "Oh, they're obviously the best thing." Still, no, they're not. Find the best bridge and then find the best mortgage. There's no guarantees with a bridge to let anyway. So, I'm a great believer that every single individual case, every transaction should be looked at on its own merits. Not just go, "Oh, do you know what? Let's go down the easy route. We'll just keep going with the same lender over and over and over again."
Great stuff. Well, I think we better watch the clock here because we're running probably on past the hour here, but it's been fascinating chat. We can't let you leave today without getting your take on the sort of current market. And, obviously, we've got rising interest rates going up each month. We've got insane inflation, which is not going away anytime soon. The property prices seem to be defying gravity. Where do you sit in terms of, are we facing an imminent crash, or what's going to happen to the property market? Let's get your view.
Cool. So everyone says, and this is where I think I might have a slightly different view. Everyone says the property market goes in a certain direction based on supply and demand. Of course it does, but we've got to look at what causes that supply and demand. It's not just lack of stock. The depressions / economic downturns / crashes occur when there's no money about. That's actually what causes them. So the credit crunch, I mean, obviously it was in the name. There was no money, so we had a bit of an economic downturn as a result. Property market suffered as a result. We've got more liquidity in our market at the moment than we've ever had in our economic history. We've got over £1 trillion of available funds to lend. It's a huge amount of money, which is actually this is what's been fueling our property market. This is what's been fueling it for the last decade. Historic low interest rates, obviously up until recently, the lowest in history. The availability of money has been easy. It's just so simple to get a mortgage, get onto the property ladder, and that in turn is what's been then causing that supply and demand deficit, because supply just cannot keep up with the demand, because the demand is fueled by how much money is available in the market. Now, obviously, we've just had 3 increases of the Bank of England base rate on the bounce. Are we going to get another one soon? 50-50, I think, on the next one, if you want my honest opinion. But when we are going to see that change in supply and demand, when demand is going to drop off enough to stop the rapid rising of prices, is going to be where it gets to that point where affordability of residential mortgages, tips it in the balance, tips the balance towards not being affordable for most people. And that will happen, when basically for the property that somebody wants to buy in their area, they can no longer afford, according to the bank, to pay a mortgage of enough value to purchase that property with. I don't think we're there yet. I think that's the reason why property prices are still going up, because people are even though the Bank of England base rate has gone up, mortgage rates haven't gone up significantly enough to make wide scale affordability, bad across the country. I think possibly 1, maybe 2 more raises will be enough. Now, I think what the Bank of England have got to be really cautious of is, I wouldn't do 2 on the bounce now. If they're going to do 1 next time around, have a break and don't raise.
You think that's going to cause a recession?
No, I don't think we're going to have the huge, depression or whatever that everyone's talking that we're going to have. It's not going to be a crash in the property market. It might, touch wood, it might look, this is just my opinion, obviously. I don't think we're going to have a property crash. I think the increases have been going on too long. It's going to deviate back to its natural line, and we might see a few dips in certain places. But don't forget, there's still parts of the country that haven't even gone past there. And when I say the country, I'm talking the UK as a whole. There's still parts of the country that haven't actually reached their 2007 highs yet. So people are talking about, oh my God, property prices have been going up. Well, property prices in Durham are not as high as they were in 2007. So actually, there's so many different microclimates, it's really difficult to make like a big overall sweeping generalization of the country. But I think I think this is why I'm thinking that maybe the Bank of England might put their rate up again next time around, see if that's enough to slow the property market down a little bit, slow growth, because it's unsustainable and it's not good for the economy long term. And if it does slow it, enough, they then shouldn't put the base rate up again, probably for the remainder of the year, in my opinion, because then they just need to have a period of settling down. And I think if the property market just settles for the rest of the year, that may well then have a knock-on effect to the wider economy. People aren't moving, therefore maybe they're saving more, maybe they're spending more. Because don't forget, if half the country wants to move, what they're doing, they're not going out and splurging it on nice meals out and all this kind of stuff. So money that's being spent in property, people moving home, is being spent in the wider economy then as a result. So maybe that then has a knock-on effect.
That's interesting. I agree with you on the affordability thing and the kind of earnings to, what's it they call it? Earnings to lending, earnings to house price ratio. Yes, well, I think that's the thing to look out for, and that's when you start seeing maybe the top of the curve in terms of things going up like 10% and stuff like that. Because like you say, the availability of credit, which is one of the fundamentals, that's going to be there, isn't it? We're not going to have that problem.
It's just going to be whether then lenders find more creative ways of getting it out the door. So, so this is where people forget is when I first started in mortgages, one of the reasons that I struggled so badly was actually because loads of clients had that I was reaching out to had these tracker rates at the time that were 0.5% above the Bank of England base rate. Some of them were even below the Bank of England base rate. So there was two lenders, Alliance and Leicester, Cheltenham and Gloucester. Glad they both don't exist anymore. They were the bane of my life for like 5 years when I first started out. They had these tracker rates that were like, as I said, 0.5% above base rate. Well, when the base rate went down to 0.1%, how often do you reckon I spoke to someone and said, do you want to remortgage? Absolutely not. Quite happy, thank you. So I can see, there might even be kind of those kind of products reintroduced again. If there's obviously was mechanisms at the time where lenders could lend to each other, but allowed them to make those smaller marginal gains than what they've been used to over the last few years. So, here's to hoping that those kind of things will maybe come back into the market.
Yeah, I like your point there on the kind of wages to house price for affordability. But I mean, what's the lender look at for a residential? I know we're kind of going off topic slightly. What does a lender look at for a residential mortgage? Is it 4 or 5 times your salary or income?
So this is a massive misconception that people have, which is that lenders work off income multiples. They haven't done for many years. We had something called the Mortgage Market Review, MMR, back in 2016, maybe, something like that, which ironically was legislation that came in from Europe. And basically it changed the way that residential mortgages are worked out to an affordability calculation rather than an income multiple. So it's basically the lender will work out your surplus income on a monthly basis and decide whether that surplus is enough to cover their monthly mortgage payment. So before, how long you had the term didn't really make much difference. So if you had a 25-year term versus a 40-year term, because it's on an income multiple basis, it doesn't make any difference. Now, if you say, for example, your surplus was £1,000 a month, let's just say, and lenders will always want to see a little bit of a difference between what you're paying and what your surplus. So they wouldn't just say, oh, that means you can afford £1,000. That might mean that they're happy with £700 a month. So if a mortgage you want to borrow is on a 25-year would be £900, they'll say, well, that's not affordable. But then they'll go, but if you put it on 35 years, it is affordable because that then goes down to 600, which is below what we're comfortable with. So it's a lot more. And to be honest with you, this is why I don't actually do a lot of residential mortgages. It's such a specialist area now. I've employed somebody to do the residential mortgages for Grand Union Finance because
it's funny you're saying that because I've never done a residential mortgage since 2016 when obviously these changes came into place or something. And I go, all right, yeah, I knew it was going to be something like that, but that's quite interesting. Yeah, because when you think about it, it couldn't have been sustained at that rate because when you were talking about there, thinking about the average, earnings of, I don't know, £28,000, times it by 5 is what, 140. If you've got a partner, you're 280 on the same income, and the average house price in Scotland is 286, I think it was, from last month. So you've already breached the a 5 times income multiplier already, and that's 2 years working in a household.
Yeah, exactly. And I think there is talk of the income multiples kind of coming back. I'm not 100% certain whether I'm a fan of it or not. I'm a big, maybe I'm quite conservative when it comes to residential mortgage stuff, but I don't believe people should overstretch themselves on the residential mortgages. Just because a lender tells you can borrow 200 grand, you've got to make your own decision as to whether 200 grand's a good idea or not. If you don't need, I'll give you a great personal example. I moved from London to the West Midlands just before the pandemic. Great time. I got to sit in a flat for 2 years, not getting to know my new area. But I said to my missus at the time, she was like, "Oh, let's go up there. We can afford a much bigger house there." I said, "Yeah, but it's just 2 of us and 2 cats. Like, we don't need a big house. So let's check out the area. Let's just try and find a little flat." It's a massive flat, but it's a 2-bedroom flat. We're renting it. And because I said, well, we don't need anything else at the moment. So people have got to live within their means. And also, this is another thing, just not wanting to jump on my soapbox too much, but this whole thing at the moment, like especially the TikTok crowd, are really going for it. And they're trying to hang me at the moment, which is, there's no divine right. No one in this country has a divine right to own a property. You've got to earn the right. We go back 200-300 years, and about 17 people owned property in the whole of the UK, and everyone else just worked the land around it, and that's how they had a place to live in. And everyone's like, "Oh, these landlords coming in and they're stealing our homes." No, they're not. They're not stealing anyone's homes. They are providing accommodation for people that can't get a mortgage and can't afford a deposit to put down on a property. There's no, if you can't afford to buy a home, that's a you problem.
Don't ban. Because they're too busy out every weekend spunking their fucking money and their affordability says they can't afford a mortgage.
Yeah. Do you want to hear something just very, very quickly? I know because you guys want to get away.
No, you go, mate.
I was watching a program on Channel 5 a few years ago, and it was called Rich Kids Get Skin or Go Skin. Have you ever seen that?
My missus is watching, actually.
It's basically it's a program about these like a rich kid will go to live with a poor family to learn life lessons. And I think, do you know what, they should do the opposite. Get the poor people to go and live with the rich people and learn how the rich live, because they probably understand money a bit better. There was a particular point that absolutely hammered this home, which was the dad of this family had 2 jobs. He had a Saturday job going and delivering leaflets, and as he was so they were talking about the fact that he had like a £46 surplus. The whole family had a £46 surplus each month, I think. And he's walking along, no lie, with a pint-sized can of Red Bull. Now, they cost about £2. So you don't know how to manage money if you've only got £46 surplus each month and you're buying a pint-sized can of Red Bull. Go to Tesco's and get a bolt. Yeah, that's a third of the price. So you clearly don't know how to manage money.
Drink tap water.
Yeah, drink tap water. Yeah, drink Iron Brew if you're in Scotland. That's probably just as expensive, isn't it?
Go to Sam Norris for your money-saving tips. How can you save on energy bills? No, we won't go there.
How long have we got?
No, that's it. Listen, Sam, it's been absolutely brilliant. Thanks very much for your time. And where can people reach out? I would well recommend the Game Loans podcast, but where can people reach out to you?
Yeah, pretty much across all social media platforms. I'm at the Sam Norris, just because at Sam Norris was taken. And if you want to go and check out my YouTube channel again, just type in my name, Sam Norris, and I'm the first thing that pops up because I check it all the time because I'm so egotistical.
And you do a Monday. You do a Monday, don't you? A live Monday on Instagram. I keep seeing you pop up.
Yeah, we're up to episode 93 weeks on the trot. Every Monday at 5 p.m, I do something called the Monday Mortgage Milk, because I love a bit of alliteration, which is basically just a live Q&A. People can ask me questions for an hour, and it does pretty well. I mean, Jesus, I get some serious difficult questions, and sometimes I'm there going, "Oh my God, there's lots of people watching. What am I going to say? I'm not 100% certain what the answer is." But yeah, come and join that too, because we have a laugh on that too.
Good, mate. Nice one.
Cheers, boys.
So hope you enjoyed that, guys. It was very, very useful. From somebody who has never done a bridge and loan, I definitely would go and see somebody like Sam to get that advice and to sort of get the best deal in the marketplace.
Yeah, it's good. It's good, and you can see chatting to Sam how important a good mortgage broker is in your power team, in your people around you, and the ones that you use. Someone like that with the right knowledge, pointing you in the direction of finance is so important. And remember, guys, if you're looking for bridging loans and going for a bridging loan, make sure you can secure your exit. I know I use bridging loans quite a lot for flips, but make sure you've got a plan B. If you can refinance it, get the money back out, pay the bridging loan off, but make sure you've got an exit, because bridging loans can get tricky if you get pulled into them and stuck on them.
Yeah, you're talking from experience as well, mate. So anyway, let's talk about our networking events. We've got Aberdeen, Dundee, Edinburgh, Glasgow, the first Wednesday of every month. We absolutely love these events. We're building the community and we're helping people, and it's just fantastic. I love it every month. I'm going to try and get round a few other venues as well. Follow us on the social media, Instagram, at Scottish Property Podcast, and tag us there. Reach out, give us a review, and let us know if you want us to cover any more topics or things that you want to learn about on the show as well.
Brilliant, guys. Thanks very much for listening as always. Appreciate it.
Bye for now.